Good morning and welcome to our next Between the Lines live event. Today I'm here in our HTL offices and we're joined by Andrew Jolliffe, who is Managing Director of HTL Property, and Rick Woelms, who is our National Director of HTL Capital. So welcome, guys.
Hey, Vanessa. How are you?
Great it's exciting. So we're talking today about the tourism pub sector. This is probably the sector that I get asked the most about, just because so much has been happening in pubs, particularly the last 18 months. So it's a really great one to kind of end the year on. Everyone's at Christmas parties, having a lot of fun, going on holidays. So let's have a chat and see how things are going. So I might start with you, AJ.
Sure.
So for the last probably 18 months, we've seen record levels of transaction activity. Let's just talk about pubs for a second. Yeah. It's been outstanding. Like, we did some work, I remember late last year, and there was new levels of high in terms of values, and then that got bucked this year with some new levels of transaction value. Yeah. So what can you tell us? Why is this huge appetite for these pub assets?
Look, there's been an elongated period of interest in pub assets, as you say, and probably dates back even prior to 18 months. So I guess in the lead up to the COVID pandemic 2020, we'd seen a couple of years of natural growth, and I think the real basis for that is the limited nature of this asset class. There are only so many of them and hugely regulated. So national, state bodies regulating these industries, local government councils, AUSTRAC, anti-money laundering, food hygiene. It's fundamentally a very, very highly, highly regulated industry, which therefore creates natural barriers to entry. So there's only a finite number of these things, in reality. So when any asset class has that, it's well positioned to be, heavily sought after, and that's what we've seen. And we've seen different types of capital coming into the marketplace as well, from traditional and long-standing families to some corporate money. So it's a culmination of those things, but the resiliency of the asset class during that.
That's what I say, during COVID, the restrictions on their trade, kind of being the closures, the square metre rules, so many different rules come into play, but still tracking out well at the end.
Do you know the record sale for a pub during the COVID year, so not the whole period was affected by COVID, was right in the peak of when there was no trade, no people. We had to do inspections, one-on-one inspections, and a pub traded around $70 million in Sydney with no trade, effectively. So it speaks to the I guess the robust nature of the product.
And you mentioned where those funds are coming in from. Can you really zero in on a particular sort of buyer and seller group that's been more active in the marketplace?
No, look, not really, although the stats would suggest that generational purchases are still the favoured, demographic in terms of who's buying. And that in and of itself, I think, speaks to confidence in the sector. And banks and valuers and other people will say, well, if multi-generation or multi-asset owners are still buying these products, it's not just new money coming in.
Yeah.
That says something about, the longevity of the space. But it's not only those families, but there would, in fairness, there'd be a predominance of experienced money and experienced operators.
So they're not just all cash buyers, though. They're having to borrow funds as well?
I don't think we've done a transaction in the last... I think we've done one transaction in the last 100 that I can think of where there wasn't debt involved. So, which is obviously, and this is Rick's expertise, but obviously, hugely rewarding too for the asset class to know that it enjoys such support from the senior lenders.
Yeah, so that brings me to you, Rick. This is really your area with HTL Capital, helping people buy those investments.
Correct, and thankfully a lot of these buyers do require finance, so that gives us a role to play as well. And really the banks have taken a lot of confidence out of the last 2 or 3 years, as we spoke about before, with resilience and so forth. What the sector has learned is that the operators, the assets themselves are so resilient they can bounce back from the most harshest of environments. And we've seen that, and the banks have taken a lot of confidence from that as well.
So is it mostly bank debt that you're seeing? Because if you look at, so I work across all the commercial markets, as you know, and we've seen so many alternative lenders come into the marketplace to help, because the banks aren't always coming to the table in terms of financing. But is it banks where you're getting a lot of your finance, or are you seeing these alternative investment vehicles coming through?
There's a lot of interest from alternate lenders, absolutely. There's a lot of participants, a lot of players who would love to have exposure to the sector. Probably the heavy lifting at the moment has been done by the major banks because they understand the sector. They've got dedicated bankers who specialise just in this sector. They know what to look for. They know who to bank, the proven operators, the right metrics. And we've seen, I guess, the larger groups be very active of late. So they're the groups that are banked by the traditional banks, and they've been very supportive, provide access to capital, and facilitated a lot of growth that we've seen. Yeah.
So even with this rising interest rate environment, like we've seen consecutive rises now for most of this year, but there's still an appetite out there to purchase, and there's still financing available.
Certainly still financing available, absolutely. I think, banks have grown very deliberately and successfully in the last few years, and I don't see that changing. They've got strong relationships with the large groups who are well capitalised, strong balance sheets, capacity to grow further, and they will look to grow with those groups again.
Well, I think with all commercial asset classes during this time where the yields have been really low, interest rates have grown. I know certainly in other asset classes we've seen a lot more insolvency come into the marketplace just because people buying at higher prices and maybe those businesses not being able to withstand the COVID period and changing in needed floor spaces, whatnot. But we're not seeing that. You're talking. We spoke earlier about how some of the banks were happy to kind of prop up some of these operations during COVID, but it was never really kind of taken up.
No, so and the banks worked really well with the groups through that period of time, and it really was a collective effort between the banks and the operators to navigate their way through a period of time they've never seen before. Pubs are shut. No one experienced that. They had to figure out how best to find their way through such a difficult time. But the banks were very collaborative in regards to what they did with each of these client groups. They provided working capital lines, solutions, waiving amortization, waiving covenants, and so forth. But to be honest with you, the large number of groups didn't really need that level of support. They were very liquid, they had cash reserves, and they managed to actually get their way through those times without requiring the assistance that the bank was prepared to step in and offer. So I think, again, coming through that period of time, the bank said, hey, look, we're prepared to jump in here and help. They didn't need that level of assistance. We've taken great comfort and confidence that these groups are well capitalised. They can navigate their way through these periods of time. Let's now go and support them to greater lengths again. So we've seen that.
Good news story for you, AJ, with the ongoing sales of assets going forward. But we saw a whole lot of sales in these last couple of years, particularly in New South Wales and Queensland, completely new highs in terms of record transactions. Yeah. Do you think that's going to continue as we look to next year? Or is there some more scope for other markets to have more activity? Because a lot of the markets, Melbourne there's been activity, but not an awful lot. South Australia, is there other markets that are probably going to see a bit more activity next year?
Look, we think so. Last year, 100 hotels transacted in New South Wales alone, more than all of the other states combined. And that was a bit of a watershed year for the state. But New South Wales has and it's a population-based thing as well. And I think it's also the nature of the ownership structures in New South Wales, or the nature of the owners maybe that are happy to transact. They're people that are happy to move assets around on a balance sheet, be quite aggressive. Whereas in some of the other markets, maybe particularly Victoria, people are a little bit more wedded to that asset, and it's more multi-generational, and that also maybe speaks slightly to the ownership structure of the gaming entitlements and various other things that are in some of those other states, as distinct from New South Wales. But we think next year is a year where certainly Queensland, which is probably the number 2 in state that we deal in terms of the volume of transactions, both it and Victoria and South Australia, which we've already seen, they will increase the number of sales, we think, quite dramatically. And New South Wales might come off slightly to compensate for that, but yeah.
So what's been pretty interesting, particularly in New South Wales, has this shift, and this has happened over a number of years, where there's been more activity in those regional markets and the coastal markets. It's not just a metropolitan piece. No. And you spoke about population movements, and I suppose that's never seen more than this COVID period. Sure. We've seen a lot of people, well, Sydney-siders moving up to Queensland, Melbourne moving up to Queensland as well, but also just moving to regional areas, coastal areas.
Absolutely.
Also the whole drive holiday market, we couldn't go anywhere, so we were kind of restricted to the state. So we saw a lot of these transactions occur that we probably hadn't seen to the volume in the past. Is that a trend we're going to continue to see? Because we've seen some large groups move into those, what would historically be non-core, but that's probably not the case anymore.
Look, we're on record saying that sort of well-worn path to those regional areas that I guess was precipitated by the COVID period is something that's going to stick around. I know there's a counter view out there that the tide will recede from those areas, but we just don't see it, being that way. The reason we don't is those areas are pretty bloody special. Yeah. So, Sydney-siders, in this state or Brisbaneites in others, or Melbourne CBD type dwellers, they finally got into these regional areas during COVID and realised how beautiful they were. In this state, the Hunter Valleys and the North Coast, the Byron regions, the South Coast, the Mudgees, due west. I mean, some fascinating places within Australia that people just hadn't connected with, or maybe they had, but not for some time, so they're now reconnecting. But what that movement of people did was actually mean that commerce could exist there. So the local pub or the local cafe, the local whatever it is, suddenly had enough patronage so that it was actually a viable proposition. And that then led to that magnetism for people from metro areas looking sub-metro, looking more regional. We just divide it. We think about the Great Dividing Range in New South Wales, and everything sort of west of that is kind of regional. Everything metro on the eastern side of that is fairly clearly in Sydney and slightly north and south. And then you look about the North Coast being coastal. But the growth in those areas over the last 2 years, you and I have discussed previously with some stats that you put together, they've been the biggest growth areas. They're there to stay. There's no question about that. We concluded a transaction last night actually in one of those areas, and by a Sydney-based group, by a sophisticated group out of Sydney, and that just tells me that those areas, there's sustainable revenue there now. There's infrastructure there now. And there's just a re-awareness that those areas are visitable.
And how about the differentiation between yield? So in the past, there was a much wider gap between these markets and a metro market. Yeah. We've seen a lot of the transactions, that gap has really narrowed. Yeah. And that's probably here to stay as well.
Look, I think that the extremity of that gap won't get back to where it was, but the narrowing may ease a little bit based on volume. But yeah, I think you're right. I mean, you look at some of those North Coast sales that were at yields that were not dissimilar to anywhere in Sydney. Yeah. And again, I get back to the point. This is a restricted industry in terms of supply. Demand has never been greater, and so when you've got that sort of dynamic happening, you're always going to get that yield compression. Yeah. And then there's only so far that these yields can go, obviously.
Yeah. So that probably takes us to the accommodation part of the market. But before I actually get there, poker machine entitlements. Yeah. That's been an area that we've seen huge, again, limited supply. So that's, supply and demand. Yeah. That would tell us.
So for the benefit of those who don't understand what these assets are, they're the physical licenses that are attached to each poker machine in any pub in New South Wales or anywhere else. And so a little bit like, I guess, you might think about a taxi license to drive a taxi. We're not talking about the physical car. We're talking about the license that allows you to drive that car. And in New South Wales, those assets have gone from, around 200,000 to, around mid 600,000, and in fact slightly higher. And we ran an auction in the office here through Xavier Plunkett of our team. That jumped that pricing by several $100,000.
Yeah, and that's set that new standard now.
Set a new standard. We think they were mispriced, for some time. I think the market would recognise that. That auction showed that. And those things are very, very limited, as you say, and they're by default very valuable. Yeah. So look, they're at a level now where potentially there is still some growth in those, but there's a bit of noise around that I'm sure everybody would have seen about gaming and the management and potential legislation discussions that are going on. But one thing about this industry is that it's always been very well represented at the political level by the national bodies and the state bodies, and there's a level of confidence that exists that those bodies will be in discussions with legislators and ensuring that there are decisions made that aren't knee-jerk. Doesn't matter what asset class you're in, whenever a knee-jerk reaction decision is made, it's often myopic and reversed at some point shortly thereafter. So there's a level of confidence around that those discussions, those ongoing discussions, will be sensible, and changes that need to be made will be made, and those that probably don't won't be.
I'm sure financing comes into play with those assets as well. They're usually wrapped up in a pub transaction, poker machine entitlement.
Absolutely, yes. So I mean, pubs will have different revenue streams. It may be a good mix between food, bar, and gaming, or skewed towards one or the other. But certainly, from a bank's perspective, it's understanding of the revenue stream, how that then filters down to the earnings profile and so forth. And the banks will have a good understanding as to what's required to be able to service the debt on their side. Yeah.
Yep. So great. Let's head back to the accommodation side of things. So pretty much, everybody is going on holidays. They want to go somewhere. They're either going internationally. We can't get an airfare ticket at a reasonable price anywhere, or there's a lot of people still happy to travel domestically.
Yeah.
Still a bit of uncertainty. They're happy with the drive market. We've got the budget airlines, still new one coming into play. So there's an awful lot of demand still for kind of this local tourism and domestic tourism. So much so we've seen a real increase in the high end of town when it comes to hotel transactions. Nothing much happened during COVID. But that's really come back, and we've seen particularly those overseas, kind of those Asian REITs coming back in the market, full force, happy to purchase those sort of investments.
Yeah.
But in the smaller end of the market, there's a lot of hotels or motels across the state that have been busy transacting. Do you have any thoughts on where that's been and where we could see that going?
I think, as you say, I mean, part of this sort of venturing into some of these sub-metro areas, you need somewhere to stay. And so a lot of that regional accommodation, maybe also the experiential market. I mean, that's an area that our accommodation team focus very heavily upon. And what that basically means is somewhere that's boutique, or that has some additional levers to it, that might be a recreational, activity, or just be in an environment that is, that in and of itself is lends itself to recreation, whether it be on trail walks and those sort of things, fishing and other activities, mountain bike riding, those sort of things. So that sort of, people wanting an experience when they go away is a powerful lever for attracting revenue. And as you say, the REITs that were, I guess, sitting offshore looking at this marketplace, sub 30%, sub 20% levels of occupancy, no one can make money at that point. Those have now come back now, and they're now 60s and 70s, and they're forecasting 80s and above now in terms of occupancy, which is obviously significantly, I guess, helpful. But the thing about our market down here is, politically it's stable. So we've looked, there's lots of instability politically around the world, and particularly in Asia. But politically, we're still a stable market. And I guess with the receding Australian dollar recently, it looks like a good place to invest. So we're seeing a lot more of those Asia Pac clients talking about 4.5-star luxury and 5-star assets. And then domestically, we're also, as we say, talking about experiential and accommodation assets. That have a point of difference.
We've seen a number of portfolios sell as well, like kind of across metro and regional markets. And how about in terms of financing? Is it the same appetite from the banks for these accommodation assets?
Yeah, it's fairly similar. We had the opportunity to work with a group just recently, and we closed that debt tender process just last week, and we had good responses from many banks. So actually probably exceeded our expectation with regards to the responses that we did receive, that there were multiple banks responding, fiercely contested, and the terms that we achieved were probably in advance of the clients and our expectations. So certainly good support from the lending groups as well.
And is it location sensitive? Does that change depending on where it is? Is it a metro regional thing, or is it a price point, or is it more about who the purchaser is?
It's a mix of both. It's going to be the operator. It's going to be the location. It's going to be the quality of the asset. It's going to be, it's a management agreement, franchise agreement, just understanding all the potential quirks that may exist with that particular transaction. But if the numbers are there, if there's proven trade, if it's the right location with the right operator, there's plenty of lenders out there prepared to support the industry.
Yeah. Like you said, AJ, the occupancy levels for hotels are definitely higher than they have been since
years,
for quite a few years, and it's growing really quickly. And in terms of average daily room rates as well, at the moment they're higher than they probably ever have been, just because there's this huge amount of demand for accommodation. So I think this Christmas holiday period is going to set new benchmarks for an awful lot of markets. Even looking at places like Cairns, which you know traditionally you don't go to Cairns at this time of the year, it's more of a kind of a winter place. It's hard to get accommodation. Accommodation's expensive, so we can see that the local market's really keen to keep travelling domestically, which is going to be great for those assets.
COVID taught us lots of things, but it taught us, I guess there were two takeaways from COVID for us, and that we think about it here. One has been that people really missed that sort of sense of community. So in a pub sense, people missed getting back to that, I guess, the nucleus around which the whole community orbits, which is the local pub, and whether that local pub be the monstrous Ivy across the road here, or the Royal Hotel in Moree, wherever it might be, people really missed that. And so when that was taken away from people for travel restriction reasons, people movement reasons, the first thing we saw was that enlivened when on that Monday when pubs opened, people got back, and even people that weren't really natural pub goers wanted to go back. People want to do those things. They want experiences. They want to travel. The other thing that it taught us is that people are happy to spend more on less now. So when I think about that in the context of what you're talking about, rather than do that overseas trip, maybe because airfares are prohibitively expensive, the dollar, maybe you're concerned about other things, but you might just take a view that I might stay at one of the 5-star hotels here, or I might go to Cairns. I'm prepared to pay a higher room rate. I'm prepared to spend more on less, and that less might be staying domestically. And we're absolutely seeing that. And I guess there are two things that we look for some positives out of that time frame, and there weren't many clearly, but I guess two that the two affected our industry and charting a bit of a course of where we're heading now. Come to mind.
Yeah, and that really kind of plays into that whole daggy motel thing. A lot of people have asked me about this because there's been a resurgence in really crappy motels that have come to market.
You mean crappy hotels? Not made crappy?
Well, yes, not made crappy. So they were they're lovely now.
Yeah. So but I'm unfamiliar with that thing.
So they've just kind of had a facelift, and they're kind of now a cool, funky place to go. People traveling with pets. There's so many new pets born out of COVID, and what do you do with your pets now? You're going on holidays, and so take your pet with you in a funky sort of place that you maybe never would have gone before. That's happened a lot, so that's kind of exciting.
Better question for Rick. He's more into the funky.
Are you into a funky
hotel? Yeah. Who doesn't?
So you'll travel far and wide, and so you'll go to a market. You probably
no distance too far for a funky hotel.
That's a stitch up. Sorry.
But it's definitely happening.
These things have been repurposed. So you think about that sort of Palm Springs style pool, small rooms, but whitewashed walls and those sort of things. And there's some fantastic ones up around Byron and Brunswick Heads. There's there's 2 or 3 in Brunswick Heads, but they don't have to be there. They can be anywhere in southeast Queensland. There's a number. I am guilty of staying in a few.
But I think that's the thing is during this time, if there was an opportunity in this kind of motel market, is that's a savvy investor's gone in there, redeveloped it, or added value somehow, and they've improve their occupancy, improve their daily room rate, and it's now kind of a destination for lots of people, particularly if you can bring a pet.
Because they've given you an experience. So you go there and you feel like you've been transported to some other place at some other time, and it's okay, and you're happy to pay a room rate that's maybe a couple of $100 a night, which is double what you would have paid prior to them doing that. And they might have some sort of facilities. They're not too great. They're not a full service offering, but you're right. They've been repurposed and reimagined. Look, similarly too with some regional pubs in Victoria and certainly in New South Wales, where you see just that whole food and beverage movement happen. There's been some great examples of that. Mr. George down in Jugiong, which sold earlier this year or late last year. A classic example of a repurposed pub, a real destination pub, somewhere to go to. People are happy to do that. People are happy to travel. People are happy to have experiences.
Yeah, well, it's definitely an interesting topic. I think that everyone's probably been really excited to hear your thoughts. But let's finish up with opportunities. What are the opportunities for 2023 in this kind of accommodation pub market? Head to you first, Rick.
Look, I would be saying that there's a lot of support and a lot of confidence amongst the banks, the alternate lenders, to continue to support the industry going forward. So those groups that are keen to get out there and to acquire and grow their portfolio, there's going to be support from the lender base. So from that perspective, I see opportunities being those groups that are well capitalised who want to go and expand. They'll have the opportunity to expand, and I don't see why they would not take advantage of that opportunity. I think that they've shown their hand in the last couple of years that there's, as AJ's mentioned, there's finite opportunities with these particular hotels. Some of them never to replace the location they operate from. And if those opportunities come to market, then there'll be plenty of buyers there willing to take advantage of that, and plenty of lenders there to step in and to assist.
AJ?
Yeah, I think Rick's absolutely right. If you've got the financial support of a lender in a capital stack, so you know that you can lever an asset. We've talked a lot on this interview about revenue and how much revenue is coming into these places for all the reasons we've discussed. So you've got access to revenue through the tools. You've got good financial support. It's an exciting time, and have a look at this. Have a look at the weather here today.
Yeah.
Just exciting. Just an exciting part of the time of the year to go out and do some transactions. And look, next year will be good. It's been a challenging period for everybody, and hopefully we get some clear air, and we get the opportunity to bring some product to market that appeals to people. And we can tell you our pipeline of things that we've got lined up for 23 will be exciting, and we're confident the market will respond favourably to that.
All right. Well, I think that probably takes us to an end of our chat today. So thanks to Andrew and to Rick.
Thank you, Vanessa.
Appreciate the chat, and hopefully that gets you all excited for the Christmas period and the year ahead for what's happening in the pub and the tourism markets. So that's it for us for this year with our Between the Lines live events. We'll come back to you in February next year, where we'll have a look at 2023 and some opportunities going forward. So thanks very much for tuning in, and we'll see you next year. Thank you.